Today we're diving into something super foundational, basic market structure. Think of this as learning the alphabet before you start writing essays. You just need to understand this before jumping into anything more advanced. Before we even talk about structure, let's clear some things up. You gotta know what swing highs and swing lows are. A swing high is formed when price pushes up, then pulls back, and that peak is higher than the candles before and after it. It's like the tip of a mountain. You'll usually spot it when the market pushes upward, stalls, and then reverses just a bit. That's what's called as a swing high. Now a swing low is exactly the opposite. Price drops, finds some support, then pushes back up, and that low sits below the candles before and after. That little dip, that's your swing low. These highs and lows are like checkpoints on the chart. They help you read the flow, like looking at the peaks and valleys of a mountain range. Once you know where those points are, market structure starts to make a whole lot more sense. All right, now let's talk about trends. There are two types of trends, uptrend and downtrend. Starting with the uptrend. Let's say price is moving up. It doesn't just shoot straight to the moon. It moves in waves, expands, retraces, expands again. So what you'll see on the chart is a series of higher highs and higher lows. That's your textbook uptrend. Price breaks a swing high, pulls back but doesn't break the last swing low. Instead, it finds support and pushes even higher. Now that's an uptrend. Now reverse that. We're in a downtrend. Price drops, finds temporary support, bounces, but can't break the last swing high. Then it drops again. So we've got lower highs and lower lows forming. That's the market tanking. Structure is bearish. Now here's the part most people overlook. When does market structure actually shift? Let's say we're in a solid downtrend, creating series of lower lows and lower highs. Then suddenly, it shoots up and breaks the previous lower high. That's your shift in structure. This is where we go from bearish to bullish. Once price shifts its structure and expands and pullback, you get your first higher low. That's where your first low-risk entry is, then followed by a new higher high. Same thing the other way. You're in an uptrend. Higher highs, higher lows. Then price suddenly drops and breaks the last swing low. Then it bounces but fails to reach a new high. Lower high forms, then price drops again. Now you've shifted to bearish. But here's the part that separates profitable traders from the one that are not profitable. A profitable trader knows that not every break above or below a high or a low is valid. So now how do you validate a real market structure shift? It's simple. You look at the body of the candle, not just the wick. If price pushes up and wicks past the previous lower high, but closes back below it, that's likely not a true break. That's usually just a liquidity grab, price sweeping out stops before continuing down. Same goes for bullish trends. If price wicks below the previous higher low but closes back above with no strength, that's not a real shift either. You want to see a strong close beyond the level with some conviction, not just a thin little poke. That's your confirmation. Otherwise, don't be surprised when price reverses and keeps going in the original trend. All right, now that you understand swing highs, swing lows, what trends look like, and how to validate a real shift, let's jump on the charts and put this into practice. In front of us, we have the euro-dollar chart on the 5-minute time frame. As you can see, price creating a series of higher highs, breaking previous higher highs and forming new ones, and later shifting its trend from bullish to bearish. Now, you might be wondering why I haven't considered this low as a higher low for the shift to happen. Instead, I took this one because that low isn't really considered a valid low. It's a fake swing. So how do we know if a swing is fake or real? For that, we need to understand the concept of an inside candle. An inside candle is a single candle setup where two or more candles form within the range of the first candle. Whichever side breaks that range, price is likely to continue in that direction, or it might even fake you out if your position isn't aligned with the daily candle's expansion. Now, moving back to the charts, as we can see here, price wasn't really forming a higher low. Instead, it was inside a candle, faking out traders who went short. Price then broke to the upside and later moved lower, shifting its structure. Now that you understand what swings and trends are, how to validate a structure shift, and how to identify real versus fake swings, you're good to go.